Let's go ahead and go through the solution to the Module 3 sample problem, example 3.4. Okay, so now we're talking about partially owned subsidiaries. So on January 1st, 18, big company purchased 60% of the voting stock of Little for $180,000. On that date, the fair value of the non-controlling interest was $120,000. Little's book value on that date was $300,000, and all of their assets and liabilities had fair values equal to book value. During 2018, Little reported earnings of $40,000 and paid dividends of $50,000. During 2019, they had earnings of $50,000 and paid dividends of $30,000. And our job, of course, is to prepare elimination entries and prepare consolidation worksheets for the date of acquisition, the end of 2018, and the end of 2019. So first, let's note that Little had the following owner's equity accounts on the date of acquisition. Common stock $100,000, paid in capital in excess of par $150,000, and retained earnings of $50,000. So our elimination entry, again, we're going to eliminate the subsidiaries' owner's equity accounts, common stock, paid in capital in excess of par, and retained earnings. That total of $300,000, whereas previously when it was a wholly owned subsidiary, that entire $300,000 would be closed against the parent's investment. Now that $300,000 is going to be split 60-40 between the investment in Little, the parent's share, and the non-controlling interest, the other 40%, which is owned by the non-controlling shareholders. Once we do that, we can go ahead and prepare our consolidation at date of acquisition worksheet. Again, and all we're doing now is simply posting debits to the debit column, credits to the credit column. So we debit common stock, additional paid in capital, and retained earnings, corresponding credits to the investment in Little and the non-controlling interest, and then we add across each row in the usual fashion. Okay, end of the first year. During 2018, Little company reports earnings of $40,000, pays dividends of $50,000. So first let's do our equity method entries. Income. Big company owns 60% of Little, therefore they own 60% of that $40,000 of income, or $24,000. So that increases the investment a little, and they record that as investment income. They receive their dividends. Again, Little paid dividends of $50,000. Big's share was 60% of that, or $30,000. And again, that reduces their investment in Little. For the equity method entries, we eliminate these subsidiaries' beginning of year owner's equity accounts, common stock, paid in capital in excess of par, and retained earnings. That total of $300,000 gets split 60-40 between the investment in Little, the parent's share, and the non-controlling interest. A for amortization is still not applicable. I for investment income. Again, we can do one of two things. We can look at our equity method entries and add up all of the debits and credits to investment income, and it works out at $24,000. Or more simply, we look at our trial balance. We see there's $24,000 of investment income on the trial balance, and that's what needs to be eliminated. D for dividends, we eliminate the subsidiary's dividends declared of $50,000, and we're going to split that 60-40 between the investment in Little, the parent's share, and the non-controlling interest. And then finally, the new element, the income to the non-controlling interest. I use the abbreviation INC for income non-controlling interest. However you choose to remember this is obviously entirely up to you. The subsidiary reported $40,000 in earnings. The non-controlling shareholders, in a sense, own 40% of that, or $16,000. And so that $16,000 is going to be allocated to the non-controlling interest, and that increases their ownership claim on the subsidiary. And again, we bring in our consolidation worksheet. Now I want to stress that this consolidation worksheet is nothing more than the trial balance of Big and Little recast into a different format. Of all of this stuff on this worksheet, the only stuff that's not directly in the trial balance are those things in bold italics and that are underlined. Net income, income, ending retained earnings, and retained earnings from the balance sheet. Again, those are numbers that are derived from other trial balance amounts. But again, everything else in here is simply pulled directly off the trial balance and rearranged into income statement, statement of retained earnings, and balance sheet sections. Okay, so again, it's time to post our elimination entries to the worksheet. First, we post our S entry, and again, I've left the zeros off in the debit and credit columns because if I try to put the zeros in, that sometimes they don't fit in my columns. We post our I for investment income entry, again, a debit to investment income up in the income statement, a credit to investment in little down in the balance sheet. We post our D for dividends entry, crediting dividends declared, debiting the investment in little, and debiting the non-controlling interest down in the balance sheet. And finally, our Inc entry, debiting the income to the non-controlling interest and crediting the non-controlling interest. Again, a couple things you need to be real careful of. There are two accounts related to our investment. There's the investment in little, the asset in the balance sheet, and there's the investment income, the income statement account up in the income statement. You need to be sure you know which one you're supposed to be working with at any certain point in time. Another possible point of confusion is retained earnings. Again, we have beginning retained earnings and we have ending retained earnings. The adjustments that we make to retained earnings are always adjustments to beginning retained earnings, and we let that adjusted beginning balance flow through the statement of retained earnings down to ending retained earnings. Finally, there are two accounts related to the non-controlling interest. There's the non-controlling interest itself down at the bottom of the balance sheet, and there's also the income to the non-controlling interest up in the income statement. So again, you got to keep track of which one you're dealing with at any particular point in time. It's a good practice to get into to just go ahead and real quickly foot those two columns to make sure that you've appropriately transcribed your debits and credits from journal entry to worksheet. So adding up the total debit column, we get 390. Adding up the total credit column, we get 390. That gives us a little bit of assurance that we didn't do anything really boneheaded. We at least have our debits equaling our credits. We might have a debit in the wrong place, but by gosh, our debits equal our credits. Okay, now we go ahead and work through our worksheet. We add across our sales and our expenses and our investment income. And again, to get a subtotal, we work our way down the consolidated column. So consolidated sales minus consolidated expenses gives us consolidated net income of $90,000. Now, of that $90,000, we, the parent, don't own all of that. We own, obviously, all of our own income, and we own a share of, or a proportion of, the subsidiaries' earnings. There are these other people out there, the non-controlling shareholders, who own a small slice of, or perhaps a significant slice of, these subsidiaries' earnings. So the income to the non-controlling interest is simply an allocation. We're saying, look, of that $90,000 of combined earnings, $16,000 accrues to these other people, leaving $74,000 for the non-controlling shareholders, or the income to the non-controlling interest. We then transfer that down to our statement of retained earnings, and then we can start working through our statement of retained earnings. Again, we add across beginning retained earnings, we add across dividends declared, and as I keep saying over and over again, whenever we get to a subtotal or an arithmetic computation, we work our way down the consolidated column. So ending consolidated retained earnings, $424,000, which we then transfer down to the balance sheet as ending retained earnings. And finally, we can fill in the rest of our consolidated balance sheet, adding across all of the assets and liabilities and equity accounts as appropriate. And again, the only really new thing in the balance sheet is we have this non-controlling interest account of $116,000. That's really analogous to our investment account. Our investment account represents our proportionate interest in the subsidiary. The non-controlling interest account represents the proportionate interest of the non-controlling shareholders in the subsidiary. If you'll note, the net assets of Little are $290,000. And whether you want to add up Little's assets and subtract Little's liabilities, or simply add up their end-of-year owner's equity accounts, their net assets are $290,000. We, the parent, own 60% of that, and that's reflected in our end-of-year investment in Little balance on Big's balance sheet in the Big column of $174,000. The other 40% is owned by the non-controlling shareholders. That's the $116,000 non-controlling interest. Okay, moving on to 2019. Again, Little reports earnings of $50,000 and pays dividends of $30,000. First, our equity method entries: income, our share of $50,000; dividends, our share of $30,000. Our elimination entries: again, we eliminate the subsidiaries' beginning of year owner's equity accounts. Common stock and paid in capital and excess of par are the same as they were last time. Retained earnings has fallen by $10,000 relative to last year because, again, last year they had earnings of $40,000 and yet paid out $50,000 in dividends, so their retained earnings dropped from $50,000 down to $40,000. But in any event, that total of $290,000 is going to get split 60-40 between the investment in little and the non-controlling interest. We do our I for investment income entry, eliminating the parent's investment income against their investment in little account. We do our D for dividends entry. Again, we're going to eliminate little's dividends declared, and we split that 60-40 between the investment in little and the non-controlling interest. And finally, we have our income to the non-controlling shareholders, their share 40% of the reported earnings of $50,000. We bring in our consolidation worksheet, and again, we post our S entry, debits to the debit column, credits to the credit column. We post our I entry. We post our D entry. We post our I and C entry. And then we add across in the usual fashion. Again, we add across our revenues and our expenses and our investment income. We have $100,000 of consolidated net income. $20,000 of that accrues to the non-controlling shareholders, $80,000 accrues to the controlling shareholders, which we then transfer down to our statement of retained earnings. We finish our statement of retained earnings, again working our way down to get that subtotal, which we then transfer down to the balance sheet as ending retained earnings. And then we finish the consolidation of our balance sheet, adding across all of our various assets, liabilities, and equity accounts, including our non-controlling interest at the very bottom.